Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're talking systematic trading. What actually is it? What do we mean by it? How can it generate returns? How can it inform the broader trading desk and organization's decision making? What have been the developments over the last couple of years? And how is it shaping the markets themselves? Our guest is Hans Balgobin, who's had a career as a systematic trader and building systematic trading capabilities, both in equities at the likes of HSBC and more recently at Shell and Millennium, and is now joining Uniper in a systematic trading role. I should express that the views discussed in the episode are Hans' personal views and do not represent those of any organisation. We have a long and wide-ranging discussion, not just on the technicalities and how to build these types of capabilities, but the strategic importance and impact both today and in the future. As always, you can really support the show by leaving us a positive review on the platform you're listening on. And as always, I hope you enjoy the episode. Hans, welcome to the show.
Thank you. Thank you for having me, Paul.
So I am looking forward to this discussion. We are talking about systematic trading in energy, in commodities. This is a topic I guess we last covered a couple of years ago. So in part it's to update where we are today, but I think also take the opportunity to lean into some of the definitions and really try and build our understanding of not only what it is, but now how crucial it is to a platform and the competitive advantages it brings. Can you just set the scene a little bit for us?
So the way I am going to describe systematic is my own view on how it is in the space. It's a vast space when we talk about quantitative and systematic. There is a big overlap in the middle in that Venn diagram, but it's not exactly the same thing, according to me. But I'm pretty sure most of the industry would agree where the difference lies. So systematic is about being systematic, repeatable, and rational in the sense that you would take inputs and get an output. The output would be your investment decision, your trading style. The quantitative side of things is about the use of a mathematical tool set, having data, using functions, using computation to take that information and then bring some kind of edge to it and then send it out to the market in some way. It could not even be about investment. It could be about risk management. It could be about, weeding out irrational decisions and potentially regulatory risks out of the picture. Now, where it overlaps is the mathematical side of quantitative and the systematic, the reason for systematic, which is to have repeatable things where you can talk to the public, talk to your own bosses and say, this is what I've done, and you will get that in a repeated fashion in the future within what we can control. Obviously, the market is a non-stationary process, so it's very hard to get exactly the same outcome, but at least you can have the same methodology for taking inputs and getting outputs. And that's where the similarities between quantitative and systematic lies. The reason why I'm saying this is where it stops, you could actually have normal, non-mathematical persons being systematic. You could have a person having a set of rules that they adhere to all the time. And that person would be a systematic person. And it could just be something in Excel, where he or she says, if this happens, I will do that. And that person may not have done any backtesting, may not have done any mathematical thinking, processing on the back of that, but that person would be systematic.
So that's very clear and very helpful. I think that distinction. This has evolved largely in equities, right? In the same process. So quantitative trading came first. You had a lot of rich data, a lot of publicly available data. That could start helping in decision making. That obviously translated into energy trading, particularly in gas and power early on, just the provenance of these things. And then systematic is that final piece where you're saying, okay, I'm going to now create a set of rules that determine actions in a set of conditions. Just the philosophy there is the benefit of adding that systematic piece at the end there. What is that? Is that because your decisions get made faster? Is it that you're removing human bias? Like, philosophically, why do you want that last bit?
So, in my mind, if you want one word, it's about clarity. Clarity of purpose, in the sense that what you would say to, why you're doing what you're doing. You can say, this is what I have set out to do, and I will always do that. Now, that clarity brings the symptoms of what you just described. So, things around speed. We get faster because you're doing the same thing in a repeated fashion. You get taking out the human error. All these things gets taken out, but it will eventually be about clarity. So I'm going to diverge a little bit here, but you know how we talk about black boxes in AI. The reason why this is an issue is because you cannot explain it to people. So having some kind of clarity around why things are happening is going to not just be good for yourself, because you can understand what you're doing. It's also going to be good in terms of, if something bad happens, you can explain to the regulator why something bad has happened. You can say, oh yeah, exactly, I've followed my steps, and we all agreed when we first started that these steps are going to lead to good market outcomes and rational decisions. But in this particular case, in this market, something happened that is not exactly what we wanted to have. But on average, it's going to be fine. So this is about clarity in the end. And that clarity brings together with it many things like speed, reduction of errors, but also it's going to end up helping you in further development of ideas. You will be able to look back over your decision making and say, something could be improved here in that fashion. If you were not keeping a systematic approach, you would have so much messiness in your past, in your decision-making process, but it would be harder for yourself to analyze what went wrong. So it's all of that. It's clarity. The word for me is clarity.
And we talk about and build up to how this complements existing platforms, and a lot of that has to do with frequency and tenor and so forth.
Yes.
Let's start with and this is the bit where I'm going to be so at sea that I'm going to need your help. But obviously, and I guess the lens here is that someone sat in the boardroom and they've got a head of systematic trading, or something has gone wrong and they're getting explained what's going on. Just some of the definitions around what's in these models and how they're built. So can you just give us some sense of graphs and nodes and inputs?
Yes. Okay. So if you think about how a person who has no obvious mathematical or systematic background will invest, it's usually they will have a thesis in their mind of how the world works, and they will look at the current state of the world, i.e., inputs data, and then they would say, okay, this is where we are, and this is what will happen next. Or given some very complex thing in their mind, but may or may not be able, they may or may not be able to put on in programming on paper and do it themselves. But it's always state of the world, model of the world that you hold private to yourself, and you send out, and you either make money or lose money based on how accurate your own internal model of the world is.
Because that's the brain, right? That's how our brains work.
That's the brain. And now, when we talk about systematic, we are saying we will try to extricate these pieces into their relevant components. So, for example, the state of the world would be inputs, would be data feeds. It could be market data. It could be fundamental information. It could be news that you scrape from Twitter, from other places. So all of these are, things that are available to you, publicly, or you have to buy it from vendors. And that is already somewhere you have to be careful about, because if some data gets corrupted or some feed gets stale, you need to be monitoring that all the time. So that's first thing. Monitoring the state of the data coming in, whether it's going stale, cleaning the data sometimes, all that is important. And that is one thing you have to give a reassurance to your stakeholders that you understand what it means to consume data and how to deal with that. That's rule number one, data comes in. Then the next thing is about, there's two ways of thinking about that. There are systematic people or even quantitative people who are data driven. And then there are people like myself who are thesis driven. So the difference between the two, it gets blurry, but the difference between the two is a data-driven person would actually say, let me run some kind of search algorithm on the data coming in through history and see what pops up as repeatability. And then they would say, oh, this is repeatable. So either they can take the repeatability and make some kind of set of rules around that, and then say if it's repeating in that way, it will keep repeating in the future.
But the danger here is you're like, when it gets cold, gas prices go up.
That's right. That's right. And it's obviously, there are other pieces to this puzzle where you're maybe by looking at a set of data and deciding that this is it. It's a bit like the allegory of a cave, the Plato's cave allegory, where you think that this is what's happening, but there's always things that would make you overfit because you're not seeing the whole picture.
Yeah. Or it's not useful, right? In other words, actually there's it hides a more interesting information, or it's information that is just ubiquitous and there's no trading edge in it, right?
Yes. So and sometimes these things are the human bias of a researcher, because that person can say, oh, I don't think there's something to be looked at here. So that betrays that there is a thesis even in this kind of data-driven approach, because we will have to filter what we think is important or not. So there's that. Now, let's talk about people who are a bit more humble, like myself, where hopefully I may be overstepping here, but when I talk about humility, I'm saying that there is a thesis to what I'm going to do, but the thesis
is a scientific method, right? This is like I've got a hypothesis. I'm now going to test it against that data.
That's right. And the word humility I'm using here is, I'm thinking carefully about the word humility, because what I'm saying here is a thesis. We know that we are coming with assumptions about what feeds we're consuming and what interpretation of these feeds, of this data, we are going to be doing. And we have to set all these assumptions in clear writing to everyone who can see that. And that bit is also, we are in a way not being humble, because we are saying the world works that way, but we are being humble enough to say, but we know that we have made assumptions, and that is something that the persons who are being data driven sometimes miss. And this is what leads to what the industry knows as overfit. Overfit, in my opinion, is the biggest issue in all sorts of trading, human and quantitative, systematic. Overfitting is where you say, this is how the world works, and I don't need any further input from outside the system, and it will work like that forever.
Yeah, which it definitely won't in our world, because obviously policies and market structure, policies change.
Yes.
Paradigms change pretty quickly,
Exactly.
In the last 5 years, the entire sort of world's oil flows have rerouted, right? So
That's right.
That's just not available. So in that sense, I imagine most commodity traders, if they're only successful, have that humility.
You have to have a bit of, that flexibility of mind to understand what is going on. Now, so we were talking obviously about how to talk back to your board member. So we talked about feeds, and I was talking about how to do the interpretation side of things and different methodology. So in the middle here is how you actually process that information. Many kinds of processors happen. So the data-driven ones tend to have things that would be looking in ultimately like a search-driven approach to defining something like clustering algorithms, or could be doing some very complex, maybe a neural network, for example, would be of that type of approach. Then you get the thesis-driven approach would be, I will create an equation in the middle, and the equation would be or a set of rules that I could explain to people. And that is what I'm going to get sign off from my boss, from the risk and from the compliance side of things. And that is what, after backtesting, obviously backtesting is a parallel thing I'm going to talk about in a bit. But this is how you build that bit in the middle. Now, there are many ways of doing that. I favor something called a directed acyclic graph, which is basically saying you have information coming in, and then you don't rely on only one single process. You don't rely on only one thesis. You build a tree of theses, and each one of them will get assigned some kind of risk, and then get mixed and matched in some ways. And ultimately, that's going to provide the sizing and the risk-taking that you need to do in terms of volumes, positions, etc. But the reason why I think about it as that, as a directed acyclic graph, is because I believe that information, when you process it, is going to have to flow in one single time direction. You cannot get information from the future, but you need to be able to get information from the past flowing in one direction so that you don't get something called a look-ahead bias, which is another set of issues. I think it's a smaller issue, look-ahead bias, in the sense that most people know how to find that. Most people in the industry know how to find and identify look-ahead biases compared to the other side of things. But what I'm saying here is the middle side of things is you have a framework that allows you to take information and process it, and then allows you to get signals that you can talk to your boss, to compliance, to risk, and get sign off. And this says how it's going to work in the middle.
Just out of interest, the guts, the mathematics of this, is it regression analysis? Are you trying to look for sort of coefficients that are statistically significant, of a series of independent variables, and then you're creating that tree?
Yeah. I would say, look, in the end, everything works on some kind of regression, because you need to, even clustering, right? Clustering sounds, this is, discrete, and regression tends to be a continuous time series, etc. But everything goes back in the language of regression. You have to go back in the past and then see what tends to move with what tends to correlate with what. Now, there is a group of people who are talking about causal inference. I think that what we tend to see is correlations. Causal inference is where you say
it's not just correlation doesn't necessarily imply causality, right? But this
exactly.
You're actually saying no, this is causal, and it's
in English common law, when you're buying a house or something, you get a big bundle of information to show the lineage of your house and how it gets to you. So it's the same thing with causality, right? Because you have to create a lineage of these things tend to move other things. And now I am on the nth node, on the nth generation of what is moving what. So you still have to create that whole tree of what is causal to what.
This is the node then. This is your
it's a similar concept, but I'm saying more philosophically speaking, the causal discussion that is being had right now is more around, they are sure they have done their homework around what causes what from the ground up. That's why we come to the level where we are right now and say, I know that when you take temperature and you take time of a year, and I take these are causal to demand in power, and then the demand in power is then causal to price in power based on things.
So matches and fire, and my house burns down. But it's the matches that cause the fire and the fire that burns my house down.
Yes, so it has to have an arrow. It has to have an arrow of direction. Yes.
Just because I have matches in my home doesn't mean it burns down, right? Yeah.
But in a way, this is what people learn as a grammar from subject and verb and all these things. So we are creating a language to understand reality, and that's what the causal people are thinking. It is still reliant, in my opinion, on ultimately some correlations quite down. But if it assumes causalities end up being correlations, then the whole house of cards can fall down in that particular way of thinking. But let's say that, in the end, everything is about regression, because you're going to see what moves what. And then, you have different kinds of techniques you use. You can use regression itself, logistic regressions, all these terms get branded around. You get more discrete approaches where you have to cluster things together, and then this works when the relationships are a bit non-linear, where you get a regime shift. And you need to be able to say, we have shifted regime right now. We are no longer in a peacetime situation. We're in a wartime situation. And then you have to go back and find where we had wartime situation. Can we infer what it means on the sensitivities of new variables, and then so on and so forth. This is the kind of stuff that you can get in that interpretation segment of the decision-making process. So we've covered data interpretation. I will quickly cover backtesting, and then I'll go into the next bit, which is about risk management and sizing, and then finally there will be execution. So backtesting is a technique that anyone can use, right? You would do that yourself by looking back over the charts and saying, oh, I would have done this at that point. Would that have made me money or not, based on my way of thinking about things? And it's the same thing done mathematically, computationally, and then you can look at the statistics that come out of this, things like Sharpe ratio, Sortino, max drawdown, all these numbers that come out allows you to quickly summarize what is the technique that you're employing going to what it has done in the past. And then you can make an assumption that it will keep going like that in the future. And then that is where it's a matter of faith at that point. So, but backtesting is very important. If your backtesting, for example, doesn't take into account things like slippage when you execute, it's already getting a bit flimsier than it could have been otherwise. So in the end, backtesting is something that has to be given a lot of attention to make sure that all the realities of the world are met in this bit, and then that is where you can get reasonable figures to show to your boss and say, this is how it would work in reality if we haven't forgotten any important bits. And the next bit would be about risk management and sizing. So you get these signals that are coming from your individual alpha strategies, etc. We will be saying we need to buy. Once they sell, maybe you created some strategies that can also give you some kind of confidence level. So you not just buy, but we think that there's a 65% chance that we will get it right or not. So this is, you can get some of these more nuanced alphas in the interpretation layer. The next bit would be about sizing and risk management. So that's where you get various methodologies. You get something efficient frontier, mean variance optimization, Markowitz mean variance optimization. All of this is around, what kind of size, what kind of bet size should I use on all these signals that I'm getting from my system to create a netted position that I would then trade in the market. By the way, this risk management and risk portfolio optimization layer should also be baked into your backtesting so that you can replicate that bit as well.
I was going to say, because this is where sort of the notional board member or, senior fundamental physical trader sort of looks askance at you and says, well, that's where all the problem is, right? Which is in the sizing,
Yes.
It's fine in equities where you've kind of, for the most part, there's sort of unlimited liquidity in most of these markets.
Yes.
Or at least sufficient liquidity to where there might only be, three ships.
Some of the markets in commodities, or some of the very important markets, can be pretty illiquid. However, let's say that if you're looking at something like Apple versus Vodafone in the UK, which when I was in equities was quite liquid, there is not much risk for you to pick something less liquid, for example, an AIM stock in FTSE AIM, and put a little bet on that, because you know that you have got hundreds of stocks you can bet and spread your risk around. In commodities, they tend to be pretty correlated things, so you would still have to put quite a big a few eggs in one basket when it comes to commodities. In energy anyway, when you can get slightly more decorrelated stuff if you go into ags, if you go into metals. There is some correlation in metals, but is not exactly diversified from energy, but maybe ags you can get some decorrelation. But yeah, sorry, I cut you off there. You were saying.
No, I was going to say, well, let's return to it, because I think that's also, am I fair in saying that that's why we've probably seen the most systematic trading, or the tip of the spear in all this stuff has been focused on NYMEX, on gas and power, more liquid markets, right? Where there is also more data.
So the data is important, definitely. So okay, so we are on that fourth component which we talked about, which is the sizing, risk management side of things, and all of that, everything that I'm saying here has to be baked into your back testing. So I'm also going to talk about execution in a bit, but you have to assume that your back test will have to have all sorts of levels of nuance when you're backtesting, so that you get stats as it would be when you start trading. I myself favor a style of backtesting called walk forward, where you say your backtesting system has no idea what's going to happen next. It's just being fed information, and it's just running through things as if it would run in real life. It goes all the way to I don't know, yesterday night or right now, and it tells you how things would have progressed if you traded in backtest all the way to now, and now you transition into real life and you start trading in real life, and everything should be as it would have been in the past. So this is all being in backtest. But yeah, so we talked about sizing and optimization layer, which is going to be saying, I will maximize on Sharpe ratio given these signals over the last year or something like that. Then you bake in information around slippage cost, etc. All of that has to be in. And finally, you get execution. So execution can be in two ways. You can, as a systematic trader, if you think that your signals are for long running positions, you can even get a signal at the close in the afternoon, and you get a CSV file, and then you execute them manually to the levels that your system is asking you to do. Or if you think that you have a system that is going to potentially react intraday, that's where it gets a bit trickier to react as a human and execute it yourself. You would want to use an algorithm, and that could be things like TWAP, VWAP, POV, percentage of volume, that kind of stuff. It goes over to the market, and then it completes the feedback loop back into the system. So these are the parts that you need to give confidence to your stakeholders when you build a systematic trading process.
The energy and resources sector is experiencing unprecedented change. To help navigate this change and capture its opportunities, HC Group launched Enco Insights, a global advisory network dedicated to the sector, providing senior advisors and subject matter experts to investment and infrastructure funds, law firms, and corporates. Enco Insights leverages HC Group's 20 years of connections in energy and commodities to give clients the expertise they need when the stakes are high and insight matters. Learn more at encoinsights.com.
The fact that I'm sort of marginally still alongside you in some of this is I think a testament to you and your description of this. This is so when we talk about execution, this is where we get into this world of high frequency versus mid frequency versus low frequency. So and then that has, which I didn't really know, but now I know from some work we've done, that obviously that has significant compliance requirements, at least depending on which jurisdiction you're in. So would high frequency be, I've done my systematic, I've set up my graph and its nodes, and I've done all my back testing and my sort of sizing and all this good stuff. I've got my pathway to trade. I then hook it up to an algorithm that directly feeds into the exchange, and it just runs. That's high frequency, right? It might be
what you described here can actually be both high and mid frequency. The high frequency side of things, I would say, is where the middle layer interpretation is actually so it needs to be so fast, usually, that it gets baked in directly into the algorithm, to the execution layer. So that's where you have to react in the microseconds sometimes. Maybe you're trading across various exchanges, making sure your orders land on each exchange at the same roughly millisecond. Because if you say you're sending an order to London versus New York, and you send the same order across the wire, and we are in Europe right now, so you would land in London first, and then it would land in New York. If someone has a faster link than you between London and New York, maybe some kind of satellite or other kinds of technology, they could realize that you intend to also trade in New York, because they have seen your London order trade before your order has landed in New York. And then they can do things like they pull their quote in New York, and then all of a sudden you're legged out, or you're out of your zone of optimality.
So of course, I mean, that's interesting, right? So of course people are building systematic trading capabilities not focused on the market, but on what their competitors are doing.
That's right. And that's where the micro side of things is important. So the information around what people are doing themselves without any big view of the macro picture is so important these days. So you may have heard that in the last quarter or so, Jane Street has made more money than hedge funds, than banks, etc. So Jane Street, when I was in KCG, was a kind of high frequency competitor. I believe that they are managing to keep going that philosophy of keeping a microstructure information and squeezing as much as possible out of that alive. They are apparently also doing mid and longer term strategies, but I'm assuming that there is a bit of work that they are doing that brings in that high frequency back into the picture.
What would low frequency be? And can you just give us, when your average merchant, your average trader, your average, in our world, in
Yes.
the physical energy commodity world, what
Yep.
prevalence is there of high frequency versus sort of this, what you're about to describe as low frequency?
So you will be seeing, high frequency, or at least mid-high frequency, is coming, quite a bit now, because you get batteries being optimized. You're getting information. In some markets, you can trade every 15-minute delivery in power markets, for example. And these kinds of markets, I think, are exactly what you need for algorithmic execution, and it could be even high frequency decision making on this information.
This is where you have to upload in certain jurisdictions, you have to share your algorithm with the exchange or with the monitor over, with the regulator.
You have to. So if you different regions do different things, but for example, if you are regulated by MiFID, you need to explain. You need to send with each order that your algorithm is going to send out. You need to attach a tag with your algo ID, and that should then be able. So before that algo went live, there would have been some kind of compliance done where you say that your algorithm is not going to be a bad market participant. It's going to adhere to rate limits, size limit, price limits, and it's not going to behave in a way that would be construed as destructive to the markets. And then every order that this algo will send will have a tag, and then that tag is then going to be used in case there's an issue later on.
And I hope no one's figured out what those tags are. And I mean, there must be a fair amount of security behind you sending over your secret sauce to.
So, well, I think there's going to be some layers. So there's always some secret source that is kept, trade secrets, because if you think about how, I've just described how an algorithmic system, systematic system is built. There are multiple layers to that. You could give algorithmic execution side of it for free to the regulator, but you would still be able to keep some stuff to yourself because of the previous processing you've done on various spots. So I would say it's not as easy to just to say a regulator would be able to just take the information I've given them and be able to recreate a profitable strategy, because there's a lot of hard work. Even the data cleaning side of things is a bit of hard work. So it's not as simple as that.
I'm getting conspiratorial now. I've been sent off down this rabbit hole of thinking about just trying to figure out what your competitors are doing rather than. Anyway, you can tell I'm enjoying this. But okay, so and I keep interrupting you. I'm sorry. Low frequency. What is low frequency?
Right, so let's talk about holding periods, right? So in the high frequency space, first, we are reacting in milliseconds and sometimes microseconds, but the holding period, so the time it takes for you to accumulate a position and then maybe divest that, would be in the minutes, tens of minutes, maybe 1 hour. So that's, in my opinion, that's how I think about high frequency. Mid frequency, you would react intraday. So you would still execute as fast as you can because you've got access to algorithmic execution. You will execute as fast as you want to execute, but you would tend to hold it for, hours to days and very early weeks. And that's where you're using information that believe would be around inventories that people have in their books, and then you would be using that together with some macro information, some fundamental information that tends to be in that kind of cyclicity. For example, I would say weather data, because weather forecasts change, you get one forecast from every 6 hours or so, I think, from ECMWF, GFS, that kind of stuff. So you're using the kind of granularity of a change of frequency of these forecasts to make your positioning align with that. So that would be, in my mind, what mid-frequency would be, in the hours to multiple days or even a week.
And so frequency is really about the holding period, necessarily than the number of trades you do in any given moment.
Frequency in terms of execution speed, that is execution frequency, where you can go in and out very fast, milliseconds, that kind of thing. But then a holding period is what I think people have in mind in our industry, as opposed to if you talk about frequency to someone in equities, maybe they have in mind the execution side of things. But in commodities and energy, I would still think that people are thinking about holding periods.
Okay, but the compliance piece comes in as a result of speed of execution.
That's right. That's right. And it's fine. There is always a chance that, regulators can still think about, I'm interested in also your holding periods. And sometimes you do see that. So companies, for example, if you work for a hedge fund, sometimes your compliance team would say, if you're buying for your own personal use this stock or that ETF, you cannot divest it over a month. You have to wait longer than a month to divest it. That's where, compliance can look into frequency, into the holding period side of things. But typically, compliance will be more interested in the execution speed. Interesting bit, I used to work for KCG, Knight Capital. It became KCG after it lost about 400 something million in about 45 minutes in the US. And that is what, and the reason for that is there was some kind of code that was checked in, and that code had a switch that was in the wrong way, and then that made orders being sent into the market at a much higher rates than it should have been, and that made a 400 million loss in 45 minutes. On the back of that, a lot of regulation caught up. So in my mind, there is three things that is caught: size of orders, and price of orders, and also the rate orders are being sent out. These three things, you will see them being managed in many kinds of other rules. But in the end, these three things, these three properties are going to be looked at very carefully by regulators. So low frequency in my mind would be things that are being held for weeks, months, and sometimes even longer, so multi-month, even a year. And low frequency is where the skill of the investor, and skill in the sense that they have to build a very good model of the world in their mind. And that has to stay for as long as possible. And it has to withstand shocks that could happen, geopolitics or change in regulations, etc. That has to withstand the shocks, and then it would still make you some money at the end of a period. So that is a different kind of systematic trading required for this. And it's a different kinds of thesis required, because you don't have enough sample size for testing that with a good level of confidence.
Fantastic. So we're going to talk in a minute about does it work and kind of where there's correlation of where it works. Yep. But just before we get there might be someone listening to this thinking, we probably, should have one of these by this point.
Yeah.
How long, just roughly speaking, and obviously this depends on the size of the platform, all of this stuff. How long does it take to roughly, what's the investment piece to stand up one of these capabilities?
So, okay, I would say the way I build it, and different people have different views on this. The two most expensive pieces is data and execution access. The bit in the middle, which is processing, that can be done very cost effectively. If you're a coder, if you know what you're doing with maths, and these days with LLMs, you can ask it anything and it can give you some code, it can give you a piece of logic. So the bit in the middle is not very costly once you know what you're doing. But data, having access to historical data where you have to get a big dump from exchanges and then getting the live data that you keep subscribing to, that bit can be costly. And we're not even adding vendors of alternative data, of fundamental data into the picture. Some of it you can get for free, which is publicly available, but then you have to invest time writing scrapers. You scrape this data and then bring it in-house. And that is quite a bit of an investment. And then the next bit would be about access to the markets. Now, I would say access to the market is a decision that you make once you have done your test, once you've got your data and your interpretability layer, you've done your backtest and you're happy. So the cost that you can get out of is the cost of data. You need that, and there would be a bit of cost that associated with running cost of your interpretability layer, which is going to be your servers, if you're in the cloud, AWS, Azure, that kind of stuff. And obviously, the people themselves that you hire, they are going to be very important. It's important that they have got the humility to understand where they are wrong, and these people can be a bit expensive as well. So that's one.
Yeah. As Rick Lee, who runs our technology practice, will,
yes,
he knows the answer to the question I'm about to ask. I should point out, and he's probably cringing as he hears it. But just in terms of those those titles.
Yes.
So data analysts and engineers, those are the people that are scraping and cleaning and collecting and
building relationships with vendors and other places where you can get data as well. That's part of their job, in my opinion.
Yeah, and then developers, the second part of the question, so the coders and all that piece, those are what are the titles of the people? Because plug in, do the APIs into the actual exchanges, that tough bit?
Yes, there are two big classes. Typically, you get quant devs and quant analysts, and the quant devs will be usually integrating data feeds into the platform, building the platform itself, a platform which is going to be containing the business models, the mathematical models that quantitative analysts tend to build. And then, so basically they build a wrapper around the work that quantitative analysts would do. In my opinion, you can get quite a few people in the industry, could be both devs and analysts and traders at the same time, but going and finding data sources, they will find that very boring. But you will have people who can do all of both the analytics and the platform building.
And is it a benefit to have people that deeply understand the energy and commodities sector? Or in some roles, is that a hindrance? If you're thinking about that kind of like, I don't want my developer with you're saying you want them with theses already, right?
Yes, I say that you want to be able to have any domain knowledge that you have is important. It's important to have people with domain knowledge in your team, but then you have one person who is more of a microstructure guy. So I would say now I do have domain knowledge, but when I left the equities world, I was in market making in a place called Winterflood, and I joined Shell at that point. At that point, I didn't have any domain knowledge in energy. I was more of a microstructure guy, where I would say people behave that way. When you're seeing these kinds of patterns of buying and selling and accumulation, that is what's happening. So I would approach it from that side. And over time, I have been able to integrate how the fundamental data that you get in commodities, how that should color the behavior of these counterparties that you're modeling in the micro world. It's a very blurry line, these two, micro and macro, but it's kind of a feedback loop. So what I'm trying to say here is, even if you don't know domain knowledge, you will be able to get in, but very soon you will want to integrate as much domain knowledge as possible to try and get some edge. Because if you're just doing the micro side of things, you are one among many people competing.
Well, and it's commodities on hard mode as well, right? Like we always say this. There's so much the nuance to these markets from a regulatory standpoint, from a physical constraint standpoint. There are only two cargoes on the water. If one turns around, that's 50% of the.
Yes, getting information, maritime information from certain vendors, that is very important. There are some analysts that just look at that.
Yeah.
So
that's where a lot of the volatility is going to, as we've covered on the podcast. Right.
Yes.
We're definitely going to run over on this, but I'm enjoying it so much. We're going to do a long episode, so our listeners will have to bear with us. But I think it's an important bit of work. Okay, so that's the team, and I guess our answer there is there are these sort of discrete capabilities, skill sets. There's some overlap between them, depending on what you're trying to do. What's fascinating there, you're saying, is actually, with the right person, that middle bit is actually, that's where you want to buy real talent. And then you want leadership with domain knowledge on the two ends, the data in and the execution out. But obviously, in a thesis-driven world, that's where the trader earns their alpha, if you'd like.
That's right. And the thesis, so a thesis is a skill. Creation of a thesis is a skill, because anyone can have a view of the world, right? You can be a conspiracy theorist and have a view of how the world works, but that doesn't mean it's going to be useful.
As we talk right now, Congress is discussing UFOs. So just
September
9th.
Well, maybe that's going to be useful to some people. This kind of
I imagine that would have a pretty significant impact on some algorithms.
Of course, and faster than light travel, right? So yes, it's important to have people who are not too dogmatic, but even then they need to keep in mind how the world works, not just mechanically, but also from how people would react. So the behavioral science side of things. So we need to understand, when this price does this, it will cause a margin call. Even if the fundamental picture is supportive, this situation would be a margin call because too many people have accumulated longs or something like that, and that would then push the price back down. So these kinds of marrying what happens across the micro or positioning side of things and the macro, which is the objective reality of what's happening in terms of demand and supply, that is quite important. In a way, if you think about this, we talked about that before, but the trading decision-making process is about information asymmetry. It's about what information is public and what is private. And the information that is private and impactful is very much underestimated, in my opinion, because it's about positioning.
That's exactly where I want to go, right? Okay, so the final segment of this, of course, is does it work? And not just obviously what returns this unit, this desk produce itself, but also how it changes and facilitates decision making across the entire organization.
Yes.
The first question there is, and I've been guilty of making this assumption, but that most of these models, certainly if you're in a hedge fund, so if we cascade it down from very transparent markets or organizations that have very little sort of physical footprint in the sector. So let's say a hedge fund, they are very good they've got lots of money, so they can buy lots of data, and they're very good at synthesizing and capturing all that public data and subscription data. The argument the thesis that we've laid out over this podcast over a while now, and we're seeing it, is actually it's the large strategics, the oil companies, the refiners, the ag houses, right, that own, there's 4 of them, they own the entire value chain, of assets. They presumably are producing significant data that is proprietary, that is private, that were that to be cleaned, system, put into the system, would make them the absolute winners for a period of time versus those hedge funds that are relying on.
I know where you're going with that, but it's not as simple. It's not as simple because even within big companies that have got infrastructure and hence data, there is a regulatory Chinese wall between the proprietary risk-taking businesses and the data that can flow from the other sides of a business into that. And that is itself going to be a bit of a leveling of a field with the normal only financial market participants. Where I think it is still useful, however, to be in a big infrastructure commodity firm is the idea exchange that you get. Because talking about things in the ideation world abstractly is not something that you can regulate because it's just about intellectual exchange, and that is where you get faster integration of ideas. But you can just keep using the normal kind of public data, but your interpretation of that public data, because of your interaction with people on the ground, is more interesting, more intricate, and more likely to be closer to the ground truth. That is where I think systematic works with big firms.
Is that just to understand that? Sorry, if I'm a large, I'm making it up, oil major, right? And
yes,
I guess this is I guess this comes down to a little bit of that. I decide, am I regulated from a regulatory standpoint? I can't run my own systematic trading, use my own proprietary data, hook into ICE or whatever it might be, NYMEX, and trade away algorithmically.
So the remits, which are reports that you send out if, for example, you own a refinery and there's an issue. There's going to be some kind of breakdown of the refinery when you have to get maintenance. Right. So that information has to be made public to the world via the remit system, and you have to make that information public to the world, and you cannot send it to your prop desk before you send that to the world.
Hello, I'm David Hunt, founder and managing director at Hyperion Search. Founded over a decade ago, Hyperion Search has helped organisations from major utilities to startups recruit their leadership teams and key individual contributors to accelerate both their growth and the energy transition. Our 3 main verticals are renewable power, energy storage, and e-mobility. The energy transition and the talent that delivers it has been our passion since day one. find out more, visit HyperionSearch.com or listen to my Leaders in Cleantech podcast, available on all platforms.
But I can, I'm still absolutely able, of course, to make all of my trading decisions. I still can't trade on that information ahead of time. I get it, right? But
Yes.
in terms of my sort of trading enabled capability, the decision making we're making around whether it's a longer term structure or whether it's whether we're going to buy whatever it might be, that physical trade, presumably that can be incredibly enhanced. The toolkit that surrounds a trader to be able to make those decisions can be significantly enhanced by capturing this proprietary data, mixing it with some public stuff, and then having decision making supported by systematic decision making.
Yes. So what I would say is, let's assume that the proprietary data is something that is going to be made public, so that everyone gets it at the same time. I know it's no longer proprietary at that point, but the understanding of what it really means when that data goes out, because people in the maintenance who maintain these oil rigs, these refineries, etc., they know. And you can talk to them because they are your colleagues if you're working for these big firms. They know what it means. They know that everyone is going to be seeing the information that you're going to be sending out. They are going to be sending out at the same time, including the proprietary desk. But you, as a proprietary desk, you can go and talk to these guys and say, in the past, when these things have happened, what does it mean?
Yeah.
How does it impact your ability to bring it back in terms of maintenance? And you build a model around what they will end up doing, as opposed to they are just sending out mechanically some kind of information for everyone to see. So does that make sense? I think that's where the edge lies.
Yeah, so I think we need to define what we mean by proprietary data. So I'm thinking of it in the sense of, if I'm a refiner, if I've done a good job with my paperwork, it might be quite hard to find, but I can look back over all these market events and see how my fleet of refineries responded, right? Decisions that were, there's also that's, in other words, your historical set of data should be more enriched if you've done a good job, or at least people should be thinking today about how they're going to capture that information more.
So in that sense, I think I'm talking about the same thing as you in that sense, because what we're talking about here is, how things would react on the back of information that goes out. And exactly. So a hedge fund, a purely financial player would not have access to the nuance around this. And you have access to that because, in a way, it's proprietary data because you talk to people, but it's not market moving data.
It's not market. Yeah. But you're able to say, we also know though that, like, for example, our traders are out there talking, and they know that so and so, actually there's only 3 ships on the water at the moment, or in other words, there's presumably richer data available. There's richer historical data.
But maybe we should, the language around this is important. So I would say what we have described here is not data that is going to be added to the system on the fly. It's more information that you take into account when modeling, doing the middle part, the nodes.
Yes.
You take that into account when you build that part of it. And once you build that, then it's here, and it's there's no issues. There is no regulatory issues around this. But we have built that with a richer understanding of a world.
Well, I think that's useful. Okay, so secondarily, in the category of does it work?
Yes.
Does this work well where does this work best? Does it work best in a system like, let's just say, LNG, where all these sort of variables can kind of be quite, there's a finite number of ships, there's a finite number of terminals, like the port depth and all this, where does this work?
So I'm going to say there's 2 types of utility that you get out of systematic. The first utility is the value of repeatable processing, where it helps management talk to their stakeholders, to shareholders, to other people, to say that we have got a component of our revenue which is going to be always reacting in the same way. So that is, a neutral. It doesn't have an edge in itself, but it helps you talk to the firm helps it helps the firm talk about how it's going to work and hence build relationships and reassurance to the markets. The other bit is, I guess, around the alpha, the edge itself. I believe that anyone, even the person what we call discretionary trader right now, is also in a way systematic, because we have built some. Everything is a spectrum of systematism, because we would be doing certain things similarly over time. So what we are saying here is the systematic bit allows you to be more disciplined, but it's really up to the person using the systematic toolkit to have alpha in the end. So maybe it becomes easier and it helps you create more systematically capable people over time. But initially, the person using that systematic toolkit is more likely to be the important factor in determining the profitability of that system, rather than just purely saying, oh, systematic is going to make money or not. So yeah. Now, that's not to say that there are certain things that are just copied across in the industry. So, for example, CTAs, it's a bit of a cliche, but I would say they are trend following strategies. So, if you're creating a systematic desk and they tell you they would be, using CTA style strategies, that will have correlations across many systematic desks in different firms using CTA strategies, because trend is your friend is a very sticky and very correlated way of making money.
Yeah.
So, yeah. But then if you tell someone that we are doing stat-ob, now stat-ob is more nuanced, because stat-ob is different kinds of relative valuations of things that someone can be doing. Also, if something is overvalued or undervalued, the person who's creating a model can decide that it can be overvalued, but the threshold or the trigger for actually taking risk on the back of that over or undervaluation will be their own methodology, which would be different from a different stat-ob person. So stat-ob, in my mind, would be more decorrelated among themselves versus a CTA style systematic desk.
Yeah.
So yeah, it depends on your mix. So, for example, myself, I run many nodes, because I don't want to decide and impose what strategy should work at a given point in time. I have a group of trend following strats. I have a group of reversion strats. There will be things like looking at relative value and carry in different kinds of ways. So all of that would be competing for attention from the portfolio optimization layer, which is just after the interpretability layer. And then that is what decides to allocate weights. It's because I don't want to say that I know exactly what's going to happen, what is going to be the next thing that takes over the regime.
In terms of that, does it work third leg? Is it fair to say at the moment, and maybe if I get, that probabilistically, shorter tenor, right, high frequency, very short tenor holding is more successful on balance than as you go toward, inversely proportional to the longer term piece, right?
So yes, there are many reasons for that being true. I would say, first of all, the liquidity means that you have more data in the shorter tenors, and that means, and more data is good for people who are quantitative, systematic, because it helps them with their backtesting. As I mentioned, the data side of things is not enough, because you need to have that flexibility of mind so that you don't overfit, because you could have decades of data and that would still not tell you how the regime would change, how the market behavior will change in the future. And then hence, this decades worth of backtesting could be worth not much for a given period of time. You are always making a bet. You're having faith that some repeatability would happen. And typically, yes, you have to have that faith. But data is important, and in short-term tenors, you have more data, and it helps you out. So you get more samples and more lives to in short-term data, and that helps you systematically.
Yeah, and then so then it's been fascinating. But so as you look forward, the developments in this have been quite rapid over the last 5 years, from it being kind of, relatively esoteric, the purview of the hedge funds and the CTAs, to now obviously being a strategic pillar for many of the merchants and the strategics as well. Where is this going over the next 5-10 years? I mean,
so I see two things. I see that there is going to be internal pressure to do more systematic anyway, because data availability is getting higher. So that market will drive itself in terms of the skill set required will get more quantitative and systematic over time. People will have to upskill, etc. But it doesn't need to be a very rough realignment in terms of skill set. It can be a gradual alignment of skill sets, and you would teach people internally to start using a system. You would make the system what are being built will have to have some kind of democratic process so that people can get involved and participate in that. So that's one thing. But then the other things what's happening in the actual physical world would be batteries, for example. Batteries have got the Internet of Things connected to the internet. The sensors and the data are being sent out there, so you could actually get information on very intricate, very granular pieces of infrastructure and decide that to balance the grid right now, we need to do this and that. So that's just one example, but I'm assuming there would be other things. Sensors would be going into grain silos to try and see what levels of things are happening. You've heard about AI coming into the meteorological forecasting side of things to get more, faster forecasts. That is more data being produced, and maybe you can have an in-house forecaster that you can run much faster than waiting 6 hours for the next forecast to come out. So that all of that is getting closer. And when I say data is the main thing. As I said, it is the most expensive part of the puzzle. So given that it's getting more ubiquitous, I think it means that it generally generates more people in the systematic space focusing on that, because to interpret all that deluge of data, you would just need people who can actually take that and make decision. That's not to say that you will not have people who can just have a very cursory look over the headlines, and these people have got some kind of model of a world that is touching on just the right things, and just from looking at the headlines we would still be able to make a judgment of what's going to happen next. But the chance of that continuing to be as good as we have had it in the past, I think gradually decreases as the market gets more efficient and more good at interpreting data over time. I think that is where it's going.
Yeah. So to theory that out, because that is fascinating, right? So, okay, in the day ahead market, or in the very short term, all markets become ever more efficient, and more, the percentage of trading becomes ever more systematized. What does that do where does that push value, right? The adjusted risk returns, because presumably that means suddenly there's people are building ever more expensive, massive machines to participate in that. That drives consolidation amongst market participants. You have to be of a certain scale and size to be able to do to participate effectively. Yeah. The number of dollars left on the table are fewer. It becomes less profitable. Systematic trade, and suddenly the whole world is thinking, well, it doesn't really, there's no money in short-term trading. Everything's about taking mega long-term bets on an industry, a sector, a country, or whatever it might be.
Yeah. So the way it happens is the game that is being played across different kinds of tenors. The game gets very crowded in the parts of the curve where there is enough data or liquidity being thrown around, and that definitely pushes the more human style players further down the curve, because that is where there are fewer samples of what happens in terms of, is there going to be some kind of geopolitical situation down the line, and you can systematize, you can backtest that as much as you want. Every war is its own thing. Every political lineage or trajectory is its own thing, and I think the branching factor that you get in this game means that your human still has closer to everything goes closer to 50-50 chances for the machine and for the human. And at that point, the human can decide that they will still have an edge there because they have the human are still the apex predators on Earth. They have a view of the minds of other humans and other societies. So what they think is better than what the AI would be interpreting for these. So they should still have an edge on the AIs on the longer term, fewer sample side of things. So that is an obvious thing. So shorter term becomes almost like a completely solved problem, and systematic systems will fight among themselves to optimize that. And then maybe that is what's happening, by the way, around why Jane Street is making so much money, because where it's focusing is just now mastering that purely through automation. There are other players like XTX as well doing very well, but that's on the equity side of things, and FX maybe. But this will happen in commodities as well. Now, maybe I've been talking about tenors, but let's talk about asset classes. So ags probably is a bit harder to fully systematize compared to things that are a bit, more flowy, like power and I would say metals. Some of the precious metals are still harder to fully systematize. So that's where you can look into that. But the rule of thumb is around data flow. I think that the flux of data being higher means it's going to be systematized, and it's going to push human players into other less data-centric places.
Mm. But the lessons, what I find fascinating about this, and this is why perhaps we're danger of the longest pod yet, but the same application, the same thought process, the same scientific method, essentially, can be applied to decisions of any tenor and scope, right? So
yes,
this is sort of the idea that, okay, my originator or my M&A activity, rather than it now being a bit of kind of analysis by my sort of, MPVs and a few assumptions and so forth. And I know obviously organizations do this already, Monte Carlos and all this good stuff. But actually you can go to your systematic desk and say, can you test these theses? I want you to help me understand the valuation of this asset I'm going to buy and how we're going to hedge it out and what it might do over the next 10 years. And that becomes a very powerful brain in the organization, is what I'm saying. So yes, you can plug it straight into the market and you can, do what you do, but actually having that capability built itself becomes kind of, whatever sci-fi movie you want, right? That's HAL. You're asking on the TV screen, hey, X, and all of that's going to get supercharged by AI as well. So having that clean data.
So you mentioned Monte Carlo. Actually, good thing that you mentioned that. So traditionally, Monte Carlo is about volatility over time and how things can change. There are going to be, I'm being unfair to people building Monte Carlos here, because some people could have very specific trajectory dependent Monte Carlos. And that could be saying when this kind of thing happened, it actually is a convergence point in the timeline. That actually means that many of the Monte Carlo realities would converge towards that point and then go back out again. So you can get these kinds of convergence points if you want to build a Monte Carlo. But the reason why it's very interesting, because there is, I think it was either the Alpha Zero or Alpha Go, one of these DeepMind AI models, when they beat the chess or the Go game, they were using something called a Monte Carlo tree search, which basically says the AI, the neural network, is creating situations in its embedding space, and then they are going to be running simulations in multiple simulations, and then they will say, okay, I'm running the simulation, this trajectory here. How likely, with the counterfactuals that I've generated over time through my training, how likely is that going to be sustained? And then you get not just a line in the Monte Carlo that is going in one direction. The line can get fainter because it's the probability of that line keeping going you can actually assess that and start saying, yeah, that is not likely to happen. So you get these kinds of opacities in space, in temporal space around what is going to likely happen. That is maybe the way you deal with lack of data, because you can say that in these very long term, very few sample size, a very small sample size problems that you're trying to solve 10 years down, you can still create what you would call temporal convergence points that you could say, yes, I don't know exactly how it would happen, but there's a high likelihood that in 3 years, given that these other things will tend to happen in various parts of the world, that would create a convergence point in Middle East. There would be something there that would touch on a product that I'm trading back then. So this is the kind of stuff that you could do. Again, this is very speculative, and maybe that is harder than what I'm thinking about right now, and it's very sci-fi. But that's how you could actually make it happen.
Is there anything that you can look at in the equities worlds where they've got this sort of 5-10 year head start in reality that we can extrapolate over?
Well, so one thing that I would say is, so in equities world, where you get you have even more what I would call analyst reports than you have in the commodities world. You have it for every company that is listed. You have it for ETFs, which are like aggregations of various kinds of weights of companies and other vehicles. The reason why I'm saying that the analyst reports themselves are going to be interesting, because you generate data just by having the analyst reports come out. So even if there's something 10 years down the line, just by having many, many analyst reports being sent out, it creates a reality of its own. And then that impacts information very far down the line around this. I'm not saying that this is going to exactly happen as these analysts would say, but at least you can trade a consensus further down the line. Maybe that is how, again, it overlaps a lot with the chat we just had about Monte Carlos, where if you have more and more analysts predicting further down the lines, maybe especially in the net zero space, for example, a lot of that is happening, then you can use that information to make relatively large bets that are going to run for a long time down the line. So in that sense, it's a bit of some kind of techniques that can be taken from the equities world. Obviously, you have high frequency space that it has taken over the equity space. That will happen, I think. That will happen in the short tenors a lot. I'm sure the market makers, the high frequency market makers, are discussing power markets across the world right now. And we will try to solve that. And these are very, very intelligent people, and we will see what happens.
These are the sort of, rather sort of opaque groups that sort of buy office space as close as possible to the LME or to ICE.
Yes. So collocation, that will be part of it. But I'm assuming there is also micro alpha that we would be looking at, where they are predicting, minutes in the future around how things will be happening, and there will be market making around that view. There could be, some firms I know, they are not even trying to get humans to code the thesis. They are actually data driven. I think at that level, you can afford to be data driven, because there's so much information that data driven, and without a thesis, you can get away with it, because you're market making and holding for minutes and tens of minutes. But these tenors would be electronified over time, and it would push people out in that direction.
Yeah, it's interesting. It's also still, in a way, it still comes back to how the markets have ever operated, right? Rather than analyst reports in equities, in a world of highly consolidated oil majors, it's a few looks at what activity they do in the window or whatever that can determine everything. But
yes. Yeah, I mean, obviously regulators tend to look very closely at that, right? So and try to prevent bad behavior.
But my point being, they still are sort of, like understanding what the counterparties are doing can be. Anyway, well, Hans, it's been absolutely fascinating. Obviously, wish you the best in at Uniper, and hopefully we can have you back on in a year or two and see whether any of these predictions have come true, but where the market is. And I think it's it's a bit of I found it fascinating to actually understand a bit further into what we talk about when we sort of throw around these terms, and how it might shape the market and what the future might hold.
It's a pleasure for me to be on your podcast, Paul. In my mind, having these long chats and conversations is actually a way for me to diarize my own thoughts, and I'll probably listen back to what I've said in 1 year or 2 years and say, oh, I've got that wrong or I've got that right. So yeah, same for me.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.